So I think it has come to my attention that many investors, particularly in the Alibaba community, is starting to say that, hey, Alibaba might be the next Microsoft. So I went ahead to crawl through the internet to see where the source of this discussion was coming from. And surprise, surprise, it's actually from YouTube. So for those of you who are new on YouTube, remember to just gently hit that like button just to make my mom proud. Anyway, let's get to the roots of why Alibaba might potentially be the next Microsoft.
Okay, my favorite one, Alibaba. So I've never seen a situation where the price was so disconnected from the fundamentals for such a high quality business that had a meaningful moat. This reminds me of Microsoft in 2013 before it took off on a historic run. So everyone knows Microsoft. Well, Microsoft went through a period after the antitrust stuff where it basically traded sideways for most of the 2000s. The interesting thing about that sideways period, the stock did nothing, okay? So you're saying, wow, they must have had a rough patch. Sales must have been kind of flattish. Ballmer missed mobile. Like, how could you miss mobile? He didn't get mobile right. He didn't get anything right. Except, over the 7 years when the stock price did nothing from 2006 to 2013, revenues were up 112%. That's in 7 years, 112%. It's not the fastest growing company in the world, but you wouldn't have thought. Huge Microsoft, 112%. Cash flow per share was up 193%. 7-year period. Stock price did nothing. Actually,
I think I'll just like to quickly jump in here before he carry on with his entire thesis and presentation. For those of you who don't know, just to get things on the record and just to paint some context, he's actually an analyst and his name is called Thomas. I actually do follow him on Twitter. He does tweet very bullish tweets around the basket of Chinese equities. And yeah, just so you know, he's an extreme bull of China, similar to me. I think he's also one of the pretty popular talking head on CNBC. He's being invited by many of the mainstream media, essentially to expound his thoughts on the bullish side of the camp, specifically for Chinese equities. So that's the perspective that he's coming from. So I'd just like to preface this. I tend to be slightly uncomfortable, especially when analysts, even hedge fund managers, like to put forth a thesis around a particular company that is up and rising, saying that it's going to model after company X, company Y, company Z, or insert any successful company here. Let me give you an example. So we do remember back in 2020, 2021, there was the hype of all the different growth stocks and saying that all the growth stocks are going to 10x or 100x easily. Everybody was saying that they're going to find the next 100 baggers. And when growth stocks started to tank in 2022, many people like to draw the example of Amazon. So just to jog your memory a little, Amazon, back in the dot-com bubble, Amazon was trading at $100. And then from peak to trough, it was down by more than 90%. I think it was trading at single digits. So from 100, it dropped to like $8 or $9 or something like that. So from that peak to trough, that 90% collapse, many growth investors were saying that, hey, look, Amazon dropped from $100 to $9, and then it went on to 100x to $1,000+, pre-split of course. And then they were saying that back in 2022, many of the growth stocks that they hold in the portfolio are going to experience the same trend. So is this going to be the case? I'm not going to say that it's impossible because sure, there will definitely be the next Amazon, the next Apple, the next Microsoft. But what I'm trying to say is this. This entire idea of constructing a narrative, it's extremely dangerous because people like to fall back on stories and the idea of, hey, this is going to be the next Amazon or this is going to be the next Microsoft. So I do understand where Tom is coming from. In this case, he's trying to paint the picture that the idea of Alibaba trading at the same valuation or even at a cheaper valuation despite cash flows, revenues, 5x, 10x or whatever the number is. But do take note of the danger of the false equivalency anecdote here. Alibaba might not go ahead to have that 20-30% CAGR after the quote-unquote lost decade that they're currently experiencing. Now, I know in the last 1 or 2 minutes, I sound slightly bearish in my commentary, but I honestly just wanted to point out this cognitive bias, and for those of you who are blindly following saying that, oh, Alibaba is going to be the next Microsoft, just be a little bit more careful with those kind of narrative. But that said, my bottom line is I'm still a huge Alibaba bull. It doesn't take away the bullishness I have behind the stock. If not, I wouldn't have like 50 or 60% of my portfolio in that company. But I'll just like to highlight the danger in terms of adopting that kind of mindset. I'm saying that this is the next Amazon, next Microsoft, or whatever successful company out there. And now let's get back to Tom.
This is the period. Stock price did nothing. Cash flows up 200%. Imagine if you owned a business imagine you owned an apartment building, okay? 2,000 units. You've raised rents by 200% over 5 years, over 7 years. You bought the building let's say you bought the building 7 years ago for $10 million. You've raised rents by 200%. Your cash flow is up 193%. Expenses have gone up a little bit. And someone comes in and says, I'd like to buy your building for $10 million. Wait, I bought it for $10 million. My cash flow is up 200% from when I bought it, and you're offering me the same price that I paid for it? And that's exactly what happens in the public markets with public companies. And that's
I think on the idea of using apartment buildings as an example, it might be also slightly dangerous. I mean, technically speaking, we all kind of understand where Tom is coming from. But the idea of a company earning money and whether is it accrual to shareholders or not, that's a different discussion. Because in an apartment building example, the money is back into your pocket, whether you use it to pay down the mortgage or you extract the cash out of the apartment. However, from a public market perspective, specifically in this Alibaba example, they don't necessarily issue out a dividend, and many of the cash that they earn, it's hang on to the balance sheet. And of course, there's this whole idea of, it's a CCP piggy bank. So as long as the money is not being extracted out or it's not accrual to shareholders, if they're not going to do aggressive buybacks and the money doesn't get back into the shareholders' pocket, then the example might not really be an apples to apples comparison. I hope you get where I'm coming from. But back to Tom.
exactly what happened with Microsoft. So it's kind of like a balloon submerged underwater. You can hold it down so long, but eventually price catches up with earning power and cash flow. It's just an economic arbitrage. And what happened here over the next 7 years, Microsoft returned 1,500%, which was a CAGR of 36% a year since 2013 when I wrote this. It may be even more. So this is a better example. This period from this period from this period, stock price did 0, revenue's up 100, cash flow up 193, earning. So you see the levels of euphoria, despondency. Where were we here? Despondency, right? No movement in price, huge movement in economics. By the way, over the next 7 years, when the stock went up 1,500%, the growth rate collapsed relative to this. So the market's a discounting mechanism, okay? And it worked on a lag basis, and that's that. So Satya Nadella is given a lot of credit, but don't underestimate what Ballmer created before Satya took the reins. Ballmer laid the groundwork, Satya took the reins. That's why people say, like, oh, when Republicans are in power, the market does worse, and when Democrats are in power, or vice versa. Look at what foundations were laid the 4 years before. Well, first off, I don't think politics ultimately has that much to do with the market. Although everyone thinks it and trades on it, fundamentally, all that matters is this. These are the numbers that make.
On the point on politics, it gets slightly sensitive, but I think the entire idea or premise of companies being able to generate profits and shareholders in return or in translation, they're going to benefit basically when they issue out dividends or if they do buybacks or they essentially give you like special dividends and stuff like that. So I think the entire mechanism is probably the same in China, but it's a lot more nuanced than that. There might be occasions of needing to donate or come out with a special project to help the governments and stuff like that. So it gets slightly nuanced, but I'll believe that the market is a rather efficient tool. So at the end of the day, we are still solely focused in terms of the economics of the business, the ability for them to generate cash flows and profits and all the good stuff. That said, I think in Microsoft's example, I think it has also underwent a very amazing transformational story. They are currently now one of the biggest enterprise solution provider out there. They command a $1-2 trillion market cap, and they're essentially running a monopoly. I'm not saying Alibaba is not going to get there, but who knows? That's why investing is so hard. If you're able to predict where Alibaba's position is going to be at in the next 5-10 years, then sure, go all in. If not, I think at the end of the day, like Tom suggested, the market is a discounting mechanism. So all we are trying to do now is trying to evaluate the business and the amount of profits and the amount of free cash flow that they're going to kick back to shareholders at the end of the day. But at least for now, it does seem like the market is unfairly punishing many of these Chinese equities, but of course, due to good reasons. And by good reasons, I'm talking about it from the perspective of an investor that doesn't want anything to do with China. But from my perspective, I think it's an opportunity of a lifetime. But we can agree to disagree.
The stocks do this, okay? Now, why am I spending so much time on Microsoft? because, got it? It reminds me a lot of Alibaba. So for the last 7 years, here's where we're at. This is a little bit old, but it's the same price basically. It's traded between 100 and 120 for the last, since June, give or take.
It's at like $80 now, but that's besides the point.
Okay, and basically from IPO to 2022, revenues are up 894%. Cash flow per share is up 559%. Earnings per share up 600%. Share price is up 0%. Okay, very much like what you saw with Microsoft. Now you can say, but politics. Why do you think Microsoft was trading so subdued? But politics, right? Antitrust, they got off track. People were worried about government regulation. They had to fight that whole thing out from 2000 to 2005. Same exact situation now. And for the first time in history, the Chinese government has said, we usually re-stimulate an economy through infrastructure investment. This time we're going to do it a little different. We're going to put all of the stimulus into consumption. And what Alibaba is a toll taker. If you're going to consume anything in China, you're going to pay a toll, like to get over the Brooklyn Bridge doesn't have a toll, but the George Washington Bridge, I grew up in Jersey, has a toll. And all the consumption that's going to be done in China over the next 2 years, and by the way, the government set a 5% GDP target for this year, I think that's conservative now with the opening, is going to come through Alibaba. So all the foundation that has been laid over the last 7 years with no benefit to the owners, as this goes into the next phase, I think we're going to see a monster benefit for the owners moving forward. Next. This is the Hang Seng. Last time the rubber band got stretched this far, relative to the rest of the world, it rebounded 156% over the next 17 months. This means many of the individual stocks in the index were up 200 to 250% over the same period. So this just shows, we're going to show how when the Hang Seng, which Alibaba is a big weight of, one of the top weights, trades down below book, what happens to the indices over the subsequent 18 months or so. This shows Alibaba's PE multiple over time. So again, this is a despondent multiple. We know the intrinsic value. The business has grown orders of magnitude. The price has not grown. So we know.
I think it'll be slightly hard for you to see it, but you can see that graph on the right-hand side. The P multiple or whatever multiple he's using essentially fell off a cliff. I'd just like to say that many of the discussions around politics, around all this macro uncertainty and stuff like that, we're still talking about China, by the way. So at least from what I understand, 8 years ago when Alibaba just listed onto the US exchange and the Hong Kong exchange, nobody cared about politics, and they were giving them or ascribing them a multiple of like 40, 50 times easy because it was a growth company. Alibaba is the future. They are able to penetrate into international markets. But then today, because of some political squabbles between Biden and Chairman Xi, and then, politics is back into play again. ADR is a huge concern. VIE structure is going to destroy American investors. It's not like this is the first day that it's going to happen. And this is not the first day they introduced the VIE structure or ADRs. So I guess 8 years ago, investors didn't really care about it. But today, it's an important issue. Somebody please enlighten me on why is that the case.
There's untapped intrinsic value there. Currently trading at 11 times next year's. We'll see what they guide next week. But I think next week's earnings, remember the quarter was shut down, fourth quarter. So that might be your last opportunity to buy in the mid-90s in our view. And then kind of from there, it's off to the races over time. So, and by the way, that multiple 11.5 compares with this historic average multiple of 28 times.
I think also one point before I forget, this idea of valuation multiples. So the entire premise of understanding a multiple is just dependent on what's the yield percentage. Meaning, let's say, if a particular company, let's not talk about Alibaba, any company in the world, let's say it's trading at a 10 times price to free cash flow, meaning 10 times price to free cash flow in 10 years, based on the free cash flow that the company is generating today, you're going to get back all your money. That's what 10 times multiple means. And if you convert it to a yield percentage, that's 10%, because 10 times 10, 100%, you get back all your money within 10 years. Simple to understand, it's simple math. So at the end of the day, if you look at it from a PE ratio perspective, meaning that based on the accrual basis, on the earnings perspective, if let's say it's trading at a PE of 10, within 10 years, you're going to get back all the money, assuming that the earnings of the company is returned to shareholders within the next 10 years. So that's how you understand the idea of a valuation multiple. So when you look at the US counterparts, you have people trading at like 20 times, 25 times your Apple, your Microsoft, meaning that investors are willing to wait for 25 years to get back the capital. But I think therein lies the fact that there is also this idea of a growth rate, because we are probably presuming that Apple, Microsoft, Google, they are going to continue to grow, so that earnings, free cash flow will continue to climb, so that it takes a shorter time for them to get back their initial capital. But that said, I think if you look back into the Chinese counterparts, many of them are trading at like 10 times, sometimes even high single digits, like 8 times. Back then, I remember Hang Seng was at 15,000, 16,000 points. I think it was trading at like 7 or 8 times price to earnings. So Hang Seng, which is an index, by the way, with a basket of equities, assuming that they have zero growth, moving out into the next 10 years, if they're trading at a PE of 8, meaning that within 8 years, you just hold the Hang Seng index, assuming that they're returning you all the earnings, all the companies in that particular index, they're going to return you all the earnings. Within 8 years, you get back your capital. And if you just take 100 divided by 8, that's around the 11-12% earnings yield. And I think at one point in time, the investors are going to bang the table and say that, hey, this is just too cheap, and I think the free cash flow yield, the earnings yield is just too great, and I'm not going to miss it. And I think there is always a price for investors to take on a particular set of risks. So do share in the comment section down below what you think of this. Is Alibaba going to be the next Microsoft? If not, I'll see you in the next video. But more importantly, I will finally see you on the moon. Goodbye!